The accounting cycle overview. The accounting cycle is a series of steps accountants follow to identify, record, and report financial information for a specific period. The steps typically include 1. Identifying and analyzing transactions. 2. Recording transactions in journals. 3. Posting journal entries to the ledger. 4. Preparing the unadjusted trial balance. 5. Making adjusting entries. 6. Preparing the adjusted trial balance. 7. Preparing financial statements. 8. Closing temporary accounts. 9. Preparing the post-closing trial balance. Adjusting entries take place in step 5, bridging the gap between recording transactions and producing accurate financial statements. Importance of adjusting entries. Matching principle. Expenses must be matched to revenues in the period in which they are incurred to generate accurate profit or loss figures. Accrual accounting. Revenue is recognized when earned and expenses when incurred, regardless of cash flow timing. Accuracy. Adjusting entries correct accounts that do not reflect their true balances at period end, such as accrued revenues or prepaid expenses. Compliance. Ensures financial statements comply with generally accepted accounting principles, GAAP, or International Financial Reporting Standards, IFRS. 1. Accrued revenues. Revenues earned but not yet recorded or received. Example: services provided but not yet billed. Entry: debit accounts receivable credit revenue. 2. Accrued expenses. Expenses incurred but not yet paid or recorded. Example: salaries owed but not paid at period end. Entry: debit expense credit liability, e.g., salaries payable. 3. Deferred revenues, unearned revenues. Cash received before earning revenue, initially recorded as a liability. Example: customer pays in advance for a service subscription. Entry: to recognize earned revenue. Debit, unearned revenue, credit revenue 4. Deferred expenses, prepaid expenses. Payments made in advance, initially recorded as assets and expensed over time. Example: prepaid insurance. Entry: to recognize expense. Debit expense credit asset, e.g., prepaid insurance. 5. Depreciation. Allocating the cost of a fixed asset over its useful life. Entry: debit depreciation, expense credit accumulated depreciation. Preparing adjusting entries. Analyze all account balances and transaction data at period end. Identify any revenues earned or expenses incurred that have not yet been recorded. Prepare journal entries to adjust the relevant accounts accordingly. Ensure that every adjusting entry affects one income statement account and one balance sheet account. Post adjusting entries to the ledger. Effect of adjusting entries on financial statements. Adjusting entries ensure income statement. Revenues and expenses reflect the period's actual operations. Balance sheet. Assets and liabilities are stated at appropriate amounts. Equity. Owner's equity or retained earnings properly reflect net income after adjustments. Practical examples. A business incurs 30,000 naira electricity expense in June, but will pay the bill in July. Adjusting entry: debit electricity expense, 30,000 naira. Credit electricity, payable, 30,000 naira. A company pays 120,000 naira for a 12-month insurance policy on June 1st. On June 30, 1 month's insurance expense must be recognized. Adjusting entry: debit insurance expense, 10,000 naira. Credit prepaid insurance, 10,000 naira. Summary: adjusting entries are fundamental to producing accurate and compliant financial statements under the accrual basis of accounting. Mastery of these entries is essential for accountants to ensure that revenues and expenses are recorded in the proper period, thereby reflecting the true financial performance and position of the business.